different way of looking at real estate, which is what my book House Fire is about. FIRE stands for Financial Independence and Retire Early. And what I started doing in Brooklyn, New York, and which I've carried in New York, and which I teach my clients is you put every monthly bill you have in a spreadsheet, your utility bills, your transportation bills, student loans, rent, food, restaurants, travel, put that all in a spreadsheet. You just really need to look at what you're spending each month and then, multiply it by 12 so you can see what you're looking at each year. And the way I teach real estate investing, especially if people are just getting started, I invest in commercial, multi 100-unit apartment buildings now, but that's a different ball game than a lot of people who want to probably listen to this podcast who want to get into real estate, and they want to buy the small multifamilies, the quads, the tris, the duplexes, things like that. And even a single family portfolio, you can use this, which is what my mindset was, because I was trying to figure out how I could leave my day job so that I could focus on comedy the full time. But by the time I finished this process, I focused on real estate the full time. So what I did is, let's say I have a $150 internet bill. I knew I would, and phone bill combined, I knew I would never be able to get rid of this. I can't buy a lifetime supply of phone or internet access. I can't go to Costco or Sam's and get buy internet access in bulk, right? I will always have this $150 internet bill following me around. And there's these math calculators and everything that you can figure out how much you need to save and put it in a mutual fund. And to have $150 a month for the rest of your life, you need to save up $45,000 and put it into like a mutual fund. And you just withdraw $1,800 a year. And typically, all the worst stock markets and everything, that'll generate, $1,800 for you for infinity. I didn't have $45,000, but I had, $25,000. And so I found a $25,000 property. I found a $100,000 property that I could put 25% down payment on. And that generated me $150 in cash flow. So all of a sudden, instead of saving up $45,000, I was saving up $25,000. Boom, buying a property, $150 cash flow, pays my internet bill. Let's move on to my next bill. Okay, my, gas and utility bill is another $75 each. Let's call it $150. Great. Let me save up at $25,000. Let me go buy another property that cash flows $150. And I just went through every single bill in my life. And then once you do that, it's easier to save up that extra $25,000 because you're already killing your bills or burning up your bills with this house fire method that I created. And with that, you're building the snowball and you're investing, and instead of buying one property a year, I was buying one every 10 months and then every 9 months and then every 6 months. And really in about 5 to 7 years, I was able to pay off, have a corresponding cash flow to pay off every single bill in my life. And that's what I called FIRE. Financial independence, retire early. And so now I've got I could focus on comedy if I wanted to at that point, but I fell in love with real estate. So I was like, screw comedy. All I'm going to do is do real estate. And now I'm making up bills to pay for. So I want to go buy a Tesla Model X. And I was like, well, I'm not going to go give Elon Musk my money. I can give him $100,000, but I can also save up, $30,000 by a small multifamily that's generating $500 a month in cash flow. That $500 pays for my car note for 7 years. And boom, after 7 years, I've got what I call a free Tesla, and I still have my house. Instead of just buying a car and waiting to save up to buy real estate investing, I every bill, every vacation I want to go on, everything I do, I go take my money, buy an investment that's going to pay for that expense in my life.
I think you had an easy choice to make. I think that people look at real estate as being a really tough, challenging field and a tough, challenging career. Your alternative was comedy. And, that's probably harder than real estate. Make a living in that. Absolutely.
Right.
That's number one. But number two, and you didn't even talk about this, which is the big elephant in the room, is that you got these properties to pay those bills. But what you're not calculating is the appreciation and the depreciation on those properties that add even more value than just that cash flow.
So I say this all the time because investors always want to buy a property in all cash, or they want to put 50% down to juice the returns or take their cash flow and pay off the principal note. And I tell them, no, 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 you want as little money in every property as possible, as long as it's still cash flowing, so that you can buy as many different properties, because each property you own comes with an imaginary lottery ticket. And what I mean by that is what you just said, that crazy appreciation that I can't predict. But I bought 2 townhomes in Brooklyn, and in my 20s. I'm 43 now, and I sold them both. I bought them both for, basically they doubled in value because the New Jersey Nets moved to Brooklyn and opened up a Brooklyn Nets stadium a few blocks from my house. And all of a sudden, my street used to be 99-cent stores, liquor stores. It wasn't, the nickname on Myrtle Avenue was Murder Avenue. And, celebrities bought my house when I sold, like Christina Ricci, who's an actress in a bunch of, the Addams Family movies. So when I lived there, it was because it was all I could afford. But when I sold, it was because it was a hot new destination, because I had these imaginary lottery tickets. I could have bought 1 townhouse, but I spread my money out as much as possible, bought 2, and these were duplex townhouses next to each other. I was buying it for the cash flow, but I got these imaginary lottery tickets that came.
I like that analogy, because I always talk about the power of the power of the cap rate. And that's how millionaires are made in the multifamily business. And it's like, I'm an imaginary lottery ticket.
Yeah.
It's like, that's where the millions come from. And you just keep doing your day job, and and all of a sudden you're a millionaire because of real estate.
Yeah. And cool. So anyone who's listening to this, don't buy because you think this neighborhood's going to turn, or this will be worth, $1 million more in 5 years. You can't predict that. Yeah. But if you buy it based on the basics of, this is a decent cash flow, it's got decent returns, it's going to cover all my expenses, it will pay one of my bills, which was my criteria, then maybe you'll have an imaginary ticket.
That's interesting, because I keep saying, and I see so many people buying multifamily for all the wrong reasons. They buy them because they want that acquisition fee, which I call it transactional money. You don't get into real estate for transactional money. That's as bad as being a real estate broker.
Yeah.
You're not an investor at that point. But the other thing too is it has to be a good investment standing on its own. It can't be a good investment because of the tax benefits, because down in Washington, they'll screw you over any chance they can.
Right.
And, you're left holding the bag. So you're absolutely right, Alan. You do it because it's a good investment and it does what you need it to do. That's absolutely right.